Well, in FinStreet today, we are going to cover about non-funded part of the balance sheet of banks. We have with us Mr. Karthik Srinivasan, Group Head, Financial Sector Rating at ICRA. Welcome to the show, Karthik. So to begin with, Karthik, how do you see the non-funded balance sheet of the banks today versus what it was 3 years ago? Has there been change in the non-funded, mix in banks?
Non-fund based limits is something which is not closely tracked in general by most analysts. What one needs to see out here is banks do have a fairly large non-funded book as part of their overall banking operations. But within that, over 80% of those relate to notional principal on FX contracts or interest rate derivatives. So clearly from a credit substitute point of view, whether it is LCs, guarantees, acceptances, that still form a relatively low proportion of the overall contingent liabilities of a bank. To put things in perspective, for public sector banks, the total contingent liabilities as reported in the annual reports, accounts to around 40% of their overall balance sheet size. For private sector banks, it's about 100% of their balance sheet size. And for foreign banks, it's well in excess of about 9-10 times their balance sheet size. But clearly, the acceptances, guarantees, endorsements, those account for a significantly lower portion. For public sector banks, that has generally been in the vicinity of about 10-12% of their overall balance sheet size. For private sector banks, again, it's been in that 9-10% kind of a range. This has not significantly changed over the last few years. On the contrary, the number has marginally come down. And the principal reason for this is both the public sector banks as well as the private sector banks have actually seen a sharp growth on the funded balance sheet size.
Karthik, from the data, small finance banks or those with MFI exposure have seen massive increase in the non-funded loans in the balance sheet over the last 3 years, the like of Bandhan and, others as well. What is your view as to what has transpired this move?
We need to understand that for most of these, Bandhan is a universal bank. Talking of SFBs are largely into MFIs, or AU is one which is not so much into MFI business. But a lot of these banks have transitioned from a very granular retail customers to some mid-corp kind of exposure as well. So given their changing profile from unsecured MFI lending to SME kind, so we are seeing some rise in terms of non-funded exposure. But again, the overall extent and the quantum is still fairly insignificant, given that the numbers 3 years back was practically nothing. In percentage terms, the jump looks high. But otherwise, SFBs and most of the other new banks have a fairly limited non-fund exposure as such.
Well, Karthik, then could you help us understand the sectoral breakup of the non-funded, largely amongst the lenders, and also how are the yields placed, in the non-funded balance sheet of the banks versus funded side or the secured side of the business that they do?
When one talks of non-funded exposures, as I said, predominantly LCs, guarantees, acceptances. So the industries which have a lot of trade finance, where you have a lot of imports, entities or businesses with large capex, these are the primary industries where you avail of a large quantum of non-fund based limits. While compiled data is not readily available, but if one looks at the disclosures given by large banks, both public and private sector, you would see that a large part of the non-funded lines come towards sectors on infrastructure, engineering, construction, and to some extent on other banks and NBFCs, given the counter guarantees and counter endorsements that we do. So by and large, these three segments, infra, construction, infra constructions, real and engineering, they account for almost 40 to 50% of the overall non-fund based exposures across the banking
Across the
system.
banks.
That trend has not materially changed over the last couple of years.
Have we seen risk in balance sheet, coming from the non-funded loans for banks in the last round of NPS? I mean, those NPS which came in, did we really see the non-funded portfolio actually slipping into NPS last time around?
We did. It happens over a period of time. What gets reported as NPS is predominantly on the funded balance sheet part. So these are non-fund based exposures which crystallize over a period of time. So, these non-fund based exposures, once they get crystallized as a funded exposure after a certain amount of period of time, then they come onto the bank's main balance sheet and consequently, depending on the situations, they may turn into NPAs.
Well, as you mentioned, so there is, the same percentage of non-funded portion of the balance sheet. So any pain do you foresee from the non-funded part of the balance sheet of banks in the coming future, like let's say for FY24 or FY25?
At a sectoral level, we don't see too much of a pressure or a risk coming on the bank balance sheet. Clearly, one needs to be wary of entities with poor credit ratings in the current context, what kind and what quantum of non-fund based limits they have with various banks. I think that's something one would need to be mindful of. But as we see at this juncture, at a sectoral level, we don't see too much of stress to fall on the banking sector. More importantly, the banking sector's core operating profitability has also been improving over the last year, and we continue to expect further improvement in the current year itself. So they should be in a position to easily absorb any minor shocks should they arise from this portfolio.
Well, thank you so much for your time, Mr. Karthik. That's a word coming in from ICRA, that about 70 to 80% of the non-funded part of the balance sheet is already secured, and not much risk is seen in the balance sheet coming from this portion of non-funded in the balance sheet.